Hi, Theo traders. This is Gianni DePoce, and today is the 13th of February, 2024. And I want to review some really important charts with you today. A lot of the intermarket warning signals that we have discussed over the last couple of weeks have seemingly finally come to fruition. And we're going to start off by looking at the US dollar, USD JPY here, breaking out to a new multi-month high after coiling really tightly within these Bollinger Bands, as well as above that key technical zone in the 146 to 148 area. So we had a decisive break higher today after some hotter than expected inflation numbers. And what we saw is the rate cut odds actually pushed back to the month of June. So if we just go back to a month ago, we were talking about potential rate cuts in March. Then it went to May, and now we're back at June. And the dollar continues to strengthen. Interest rates continue to rise. The CPI print didn't help. Stocks are selling off, being led lower by chips, as I'll show you in a little bit. But the dollar was the big warning sign, as we've discussed, and we finally got confirmation on that front. So on this, looking for a retest of that high from November at the very least, and potentially much higher prices. And that could have some major ramifications, not just for the dollar, but for the Japanese yen as well. We see here against the euro, the dollar displaying some notable strength here. Looks like we just broke below an inverted saucer formation. So as well in this currency pair, I'm looking for a retest of the lows from the fall. So now the question becomes, and I've posed this question in recent videos, can stocks figure out how to rally with the US dollar? We know it's been done before. It can be done again, but it just means that there will be a major shift in various macroeconomic trends. And if the markets cannot adapt to that, we could get a sell-off of significance. Now let's go ahead and check in on the S&P 500 ES futures, down 1.5% as of this video. I have this drawing here because this is kind of what I'm expecting. I'm looking for a corrective decline, retest of former resistance turn support, completion of a higher low, and eventual resumption of the bull trend, because I am of the persuasion that we will see stocks rally in conjunction with the dollar. I think markets have just been extended, overbought, a little bit of too much bullish sentiment, euphoria baked into this market. We need to reset sentiment a little bit, shake out some of the weak hands, get through the rest of this earnings seasons, perhaps, recalibrate some of the rate cut expectations going forward before we can eventually make our way back higher. But I don't think this bull market is over. That said, I think that the opportunities that we need to be on alert for have shifted. So it's been a situation where tech and growth chips have been the name of the game, looking for breakouts in that space. You can see that the NASDAQ 100 futures are actually leading the market lower today. And that's typically a risk off sign. And you also see that strength, or that weakness rather, confirmed from the semiconductor sector, which, as I've explained before, is kind of like a leading indicator within a leading indicator. That is, you usually see semiconductors outperform tech on the upside and then underperform against tech on the downside. And we're seeing that happen today. Now, when you get into the late cycle of an equity market, there tends to be more opportunities that emanate from the energy space. And I've argued in the Theo Trade chat room over the last few months that we've entered a new macroeconomic environment whereby inflation is actually bullish for the dollar. So it used to be the case that whenever the dollar sold off, crude oil would rise, and whenever the dollar rallied, crude oil would fall. But I actually argue that correlation is flipped, and probably will be the case for a while now. And the reason why is that every time crude oil rallies, it pushes interest rates higher and it amplifies the carry trade. So why own euro denominated assets? Why own yen denominated assets when you can have dollar denominated assets which pay you much more in terms of yield and are much more liquid? This is the question that we need to ask ourselves when positioning and searching for relative strength in the market. Not only that, but when you get into the late stages of an equity market cycle, energy just tends to outperform. And so we've talked about some opportunities in the energy space. I like Petrobras, the Brazilian state oil company. We've been holding above this former resistance turn support here for a couple of weeks. As long as we hold above there, I think the price action is pretty strong. And then also we've had a position in Liberty Energy, which rallied to a new multi-month high just a couple of weeks ago. And it looks like we're on the precipice of completing a higher low. Now, another stock that's really on my radar right now is PBF Energy. Not only does this stock check off all of my factors to get long for it, not quite yet, but we're almost there. But its fundamentals are very strong too. And, I'm a technicals first, fundamentals second type of trader. But this is a really discounted stock, a value investor's dream, I would argue. And I think it's one that we should keep on our radar as evidence builds that we are in the late stages of this equity market cycle. And it may have just rolled over, in the near term. So, that being said, I think that the probability for weakness and turbulence in the equity space is a bit elevated, going into the back half of February, which I would remind you is a seasonally flat and or slightly bearish month. So, you have some cyclical factors to consider there as well. But I don't think that, seeing inflation come in above estimates is necessarily a bad thing for the overall economy, because it means that the economy will probably be able to handle higher rates of interest for longer. And I've said for a long time, we need to rue the pivot, because once the Fed actually pivots and starts cutting rates, it means that something is breaking. Now, on that topic of relative strength, which I mentioned a little bit ago, one of my favorite things to do when stock markets are coming down is to go through our holdings and see which ones continue to display relative strength, because relative strength is not just something we look at on the upside. That is, if the S&P 500 is up 2%, our holding should be up 3, 4, or 5% in order to pass that relative strength test. But it's also on the downside too. So if the S&P 500 today is down 1.5%, I want to take a look at one of our longest holdings in our portfolio, which is CrowdStrike. We bought this at the beginning of October. It's been a really nice winner for us. We continue to tighten up our stop losses and let the profits run on this. This stock is actually up on the day. So it absolutely satisfies and passes the relative strength test. It is displaying relative strength against the index. It is up on a day when the market is down. And we also see that in Advanced Micro Devices, which is one of the semiconductor stocks that we've had on the books for quite some time. And this is especially notable because not only is tech leading the market lower, at least with respect to the NASDAQ outperforming the S&P to the downside, but also it's outperforming its semiconductor peers within the semiconductor index. The Philadelphia Semiconductor Index is down over 2%, and Advanced Micro Devices is down about 0.7%. So this is a really healthy exercise, and it's been a few months since we've been able to do this, is to look at which stocks in your portfolio are holding up better than the overall market. And chances are, once the market bottoms, those are ones that are most likely to display a renewed round of leadership again to the upside. So if the S&P is down 5%, what we own, in theory, should be down less than that. And that would therefore increase the odds that on the subsequent upturn, it will outperform to the upside. So, there are some caveats to, if you're in a high flying, high beta name, yeah, you're going to have more volatility, but, that's just an exercise that I found very valuable over the years. But overall, definitely continue with my cautionary tune that we began to sing a couple of weeks back. Could see some downside the next week or two, but I think this is just a mild corrective decline in the face of a very overbought, strong market. And once this low is completed, I do expect a return back to new all-time highs. So that's all I had to share with you today, everyone. Thank you so much for watching, and I hope to see you in the Theo Trade chat room.